Hello and welcome to our discussion on financial accounting. In this session, we'll focus our attention on the financing decisions and financial statements. Along with that, we'll also understand the impact of the dividend, both cash and stock dividend, on the financial statements. Let us take an example. With the opening balance sheet given and a set of transactions given, we will try to convert these transactions into financial statements, and we make an assumption as of now that there is no dividend or entire profit has been retained. So issued 10,000 shares of 10 at 15. So it is a financing decision because you are raising money from the market. So capital is 10,000 into 10, so that is 100,000. Capital will increase by 100,000. So capital raise is a receipt and increase in capital. Share premium, the balance is considered to be the share premium. So the excess of the issue price over the face value, in this case it is 5, is the share premium. So the share premium is not an income but a capital receipt, and this will become a part of the equity. Issued 211% non-convertible debentures of 1,000 each on 1st April, and interest is payable on 31st December. Let us first recognize the transaction. So 11% non-convertible debentures is a raising funds through the sale of debenture. So it is a financing decision, and it's a receipt and a corresponding increase in the sources. And the sources here is NCD, non-convertible debentures. So the non-convertible debenture is 200,000, will appear on the balance sheet as a liability. Sold 60% of the stock for 400,000. It's a normal sales. So sales is equal to 400,000, and it is for cash. So there is a receipt, an income and a receipt, and the corresponding cost of goods sold as per the matching principle is 60% of the stock sold. So therefore the corresponding cost of goods sold is 180, and the stock will reduce to the extent of 180,000. Salary is due but not paid. Salary is an expense but not paid, so it becomes a liability. So outstanding salary will appear on the balance sheet as a short-term or a current liability, 50,000. Depreciation for the period. Depreciation for the period is a reduction in the value of the asset to the extent of 50,000. No cash flow, but the accumulated depreciation will increase to the extent of 50,000. Accumulated depreciation will now become 100,000, and no change in the fixed asset. Fixed asset remains at 400. Depreciation is for the period, and accumulated depreciation is up to the period. Now interest on non-convertible debentures. Since the non-convertible debentures have been issued on 1st April, the interest will be for the full year because of the accrual concept. However, interest is paid every year on 31st December. So therefore, interest on non-convertible debentures will be paid to the extent of up to 31st December. That is for 9 months. So the amount payable as interest is 3/4 of the amount due for the period. and the balance will be shown in the balance sheet as an outstanding interest on the non-convertible debentures, which is 22,000 minus 16,500. Interest on loan is for full year 12% on 300,000, and we assume that we paid that loan fully by the end of the year. So therefore interest will be 36,000, a payment and an expense. All transactions done, so we'll find the profit. The profit before tax or earning before tax is 400,000 minus 338. Earning before tax is 62,000, and tax is 30% of that, 0.30. So 43,400 is a profit after tax or net income. And here we have made an assumption that there will be no dividend, or entire profit is retained as the so therefore the retained earnings or the retained profit increases to the extent of 43,400. And the tax has been fully paid, assumed to be paid. So we can now find the total cash in hand. Cash in hand is a cash available minus the cash payments. So cash available is 950,000 minus 71,100. So cash in hand is 878,900. So no other transactions. Income statement done, cash flow statement done. Transfer the PAT to retained profit, transfer the cash to cash in hand in the balance sheet. So we'll close the balance sheet, no change in the loan, no change in the creditor. So the total sources of the business is equal to, as on 31st March 2012, is 1.2 million, and total assets should also be equal to 1.2 million. So when the no dividend has been declared or distributed, in other words, when entire profit is retained, the retained profit increases to the extent of the profit. And we'll now understand the effect of that on equity. The equity of the firm is a capital plus share premium plus retained earning. So equity was 450. Equity went up to 643,400 because of the issue of capital and also the current profit. The number of shares increased from 5,000 to 15,000. So the book value per share, which is equity per share, reduced from 90 to 42.9. Now we will try to understand the effect of the dividend on this book value per share. All other things remaining constant, we'll see how the distribution of dividend will affect the book value per share. So all other things remaining constant, if the company declares cash dividend, 100% of the original capital or the opening capital, no change in any other item except the distribution of dividend in the cash flow and the retained earnings. So the retained profit will change because the closing retained profit is equal to opening plus the current PAT minus the dividend. So the closing retained profit reduced and the cash flow to the extent reduced. So the book value per share reduced from 42.9 to 39.6. the reduction is because of the further reduction in the equity, and the reduction in equity happened because the retained profit reduced, and the retained profit reduced because we distributed dividend in the form of cash. Will this be the same effect if there is a stock dividend? So stock dividend, unlike the cash dividend, there will be no change in the cash flow because the profit is not distributed in the form of cash, but the profit is converted into the capital. So the amount of dividend is given is same, 100% on the capital. But in this case, unlike the reduction in the cash flow, no cash flow, but capital increases by 50,000. So the equity remains same. There is no change in equity as the previous one, 643,000. Equity reduced from, in case cash dividend was declared, from 643,400 to 593,400. But when the stock dividend is declared, the equity remained at 643,400. However, the book value reduced because the number of shares increased. The number of shares increased because the capital increased. Capital increased because the dividend has been distributed in the form of shares. So therefore, whenever a financing decision is taken in the form of issue of shares or issue of any liability, the impact of that may be in the form of interests, or impact of that may be in the form of dividends, besides the initial recognition of recording capital, premium and the corresponding liabilities. Thank you very much.